let's go through what we have to now, which is, if you could, let's remind ourselves where we are. We're exactly at the halfway point of the course. Not to get people unnerved, just bear in mind, before you blink, it will be Thanksgiving, and right after Thanksgiving or soon thereafter is always our exam will soon there follow. So all of a sudden things will really speed up. So just bear that in mind. Jonathan?
What's the date for our final?
Right now I think it's December 6th. Okay?
Remember, we're not coming on Wednesday.
We are not coming Wednesday, and I still think it's December 6th will be our 14th class. Okay, I'll count again to make sure. The final exam, and I'll say this, I'll try to say, if it were possible and if you have an issue, tell me sooner rather than later. I was thinking about starting the exam because of traffic and parking and making sure everyone gets here that week at 5:15 if that doesn't cause alarm bells. But if there's an issue, shoot me an email and say what your issue is. I'll try to figure it out about the final exam. The final exam probably will, same format, 2.5 hours, maybe 2 hours. I don't know yet. We'll cross that bridge when we get there. All right, but in terms of material, the good news for your team is that we're not going to finish the entirety of the textbook, but we'll get pretty far, okay? So the last chapter, for example, deals with the taxation of S corporations. Registration will open soon. If I didn't detract people from pass-through entities, and like I said, pass-through entities may be the hottest commodity ever imaginable come January 1st if this tax reform legislation goes through. So just know in advance that this course, and if you're interested in January, taxation of S corporations will be offered. You might want to get a seat before it's sold out. How's that? But we will not be covering that in this class. So, but you'll be in good shape for that course because many of the concepts are very similar. All right. So just to remind ourselves in context, because we haven't met for 2 weeks, let's just quickly flip pages because we have a fair amount to cover tonight. You guys can, again, chapter 1 is one of those chapters, easier to understand in the rearview mirror. Chapter 2, dealing with contributions of property. Again, I've said this in corporate tax, I'll say it here, in partnership tax. 721, 351 is the analog in the corporate area, is not a one-shot deal, meaning you can have a 721 event anytime in the life cycle of a partnership. So even at the very end, you can have a 721 transaction. Similarly, in the corporate tax area, Code Section 351, you can have any time. So sometimes accountants and attorneys mistakenly say, oh, 351, that happens at the beginning or it doesn't happen at all, or 721 happens at the beginning or doesn't happen at all. That's not the truth. Fake news, all right? Aside from being fake news, is the reality that 721 can happen, unlike in the corporate area where you need 80% or more control under 368C. In contrast, 721, the red carpet treatment is blazing. No issue, no problem. When, in your mind, what do you say to clients, Luca, to warn them when might they recognize a gain when it comes to capital contribution?
Exchange of services.
Well, that's true. Okay, I agree. What else? So we're going to see that more in next class, but contribution of services in return for capital interest in a partnership. Right. If they contribute property subject to a liability and they're shedding debt, right? There's potential, right, income recognition because it's considered a potential distribution, right? And what do we need to examine if it's considered a distribution? Are distributions normally taxable? Are distributions normally, Jonathan, distributions normally taxable or not?
Yeah.
Are they?
Well, no.
Let's see.
Yeah.
Gotta be careful. You want to project it. command with your clients. Generally, what do you need to know? How do you calibrate if it's taxable or not, Jonathan?
If it's in access.
Just don't keep your hand away from your lips. Tell me, I'm the client. You gotta look at me. Power.
If it's an access of basis.
Right. What the outside basis is. So what's important is what is outside basis, because depending on what's distributed, it may or may not trigger a gain. But what's pivotal is normally partnerships, just keep in mind, just very fundamental, you get taxed whether or not there is a distribution, right? If there is a subsequent distribution, depending on your outside basis, you may or may not have income. Often you do not, right? So just be forewarned, if a client shoots you an email and says, gee, I'm making, I'm forming a partnership subject to a liability, excuse me, they say I'm forming a partnership, just don't write back, don't worry, it's never taxable, right? That's a recipe for disaster, because if they're the one case in three, I mean, people often contribute property subject to a liability, you got to be forewarned and be careful about that, right? All right, and what do we want to know about the liabilities? They come in two flavors.
If it's recourse, non-recourse?
Recourse or non-recourse, right? Everyone agree? Recourse or non-recourse. So, and we're going to learn today very different implications, whether it is a recourse versus non-recourse. And you got to know that, and we'll look at that more specifically today. The authors do cover in bit the issue of recourse and non-recourse in Chapter 2, because they talk about property contributions when property might be subject to liabilities. All right. Then in Chapter 3, we talked about partnership operations in general. This partnership as an entity. We looked at how the assignment of income doctrine takes a back seat. We talked about the taxable year, how to determine that, and we had an exam question, which we'll look at today on that. We talked about limitations on losses, right? And that these are, 704D talks about outside basis, which is not surprising that you need adequate basis before you can take a loss. And then, in addition, we looked at issues pertaining to at-risk rules, Code Section 465, and Code Section 469, right? Passive activity loss limitation rules. All right? Then we moved on, once we finished that chapter, we looked at, I say jokingly, the piece de resistance, which is partnership allocations, which is how partnerships differentiate themselves from all other entities, the flexibility, right? Chapter 4 is to emphasize the flexibility, and if you recall, you need to meet the C test, as in SEE, right? Substantial economic effect. And we looked at capital accounts, right? Were taxpayers going to honor capital accounts, right? Would they honor their capital accounts, including deficit capital accounts? If they wouldn't honor the deficit capital accounts, they would have to meet the alternative test, qualified income offset. And then with the word substantiality, we looked at both transitory and shifting allocations. But if you read Chapter 4, there was a lot of carte blanche given to partners and members about how they allocated it, as long as it was reflected in their capital accounts, because, hey, capital accounts represent their economic stake, and if you want to allocate it in certain ways, that those are big economic consequences. And keep in mind, if you're considering a tax rate of 35%, economically, every dollar you're allocated of deduction costs you a dollar. The tax savings will only save you 35 cents. So before your clients get too fancy saying, give me all those deductions, I really want those deductions, you better explain to your client that's okay, you may get the deductions, but bear in mind there may be significant economic consequences if you're going to take this for real, right? So just be careful to claim who says that and you honor their wishes, and then they turn around a few years later wondering why are they coming out with so little money from the partnership. All right, so we went through partnership allocations and when they're respected, and we talked about the second half of that chapter about the fact that non-recourse deductions can have substantial economic effect. They can have substantial economic effect because even though the accounts go negative, there's no obligation to restore. But they can be respected or will be respected if the partnership agreement includes a so-called minimum gain chargeback, so that if you got the benefit of that deduction, when there's a subsequent reduction of the non-recourse liability, that as long as you're charged with the income, okay, Congress will permit that, or at least the Treasury Department will. And we finished up chapter 4. We then look at chapter 5. Okay, so chapter 4 really talks about flexibility. And I said that chapter 5 says, notwithstanding the supposed flexibility, chapter 5 puts some limitations on that flexibility. And the first of which is with respect to contributed property, right? We don't want people to contribute property with embedded gains or embedded losses and be able to shift that income or losses to other parties. And Code Section 704C puts limitations on what taxpayers can do in terms of the shifting. Right? And the midterm exam and the final exam will probably have some more of these kind of problems. Just pointing out that if you bring certain, or the contributing partner brings certain attributes to the table, they have to suffer the consequences of the benefits associated with bringing that particular property to the table. We looked at that. And if you bring on a new partner to an existing partnership, the same sort of philosophy applies. Again, we have an existing partnership, a new person comes along, the partnership has to take into account the difference between the book value and the adjusted basis of the property at that time. And there's different ways of handling it. There's traditional method with curative allocations, and the remedial method, right? And we looked at this with respect to the sale of property and also its depreciation, right? And again, why is this here? It's just to point out that, yeah, partnerships are flexible, and some people, attorneys and accountants think anything goes, but you could tell them, no, your partnership textbook points out that not everything goes. With respect to contributed property, there are some significant limitations on how you allocate income, losses, and depreciation deductions, right? So everyone bear that in mind, because again, there is a lot of misinformation out there and a lot of people wanting to ignore things. There's also, anytime you deal with family members, right? You guys may remember, some of you are in my income tax even now. Anytime you have transactions with family members, sale or exchange, right? Code Section 267 disallows losses. Or if you have a sale of depreciable property to a related party, Code Section 1239 says, nope, can't get capital gains, got to be ordinary income. Well, if you have family partnerships and you try to play games with allocations of income and losses, likewise, notwithstanding the flexibility of partnerships, there's Code Section 704E that puts the brakes on. Towards the end of the chapter, it talked about varying interest, that you can close the books or you can prorate it. At the very end of chapter 6 about how to allocate partnership income. Our objective today is to finish chapter 6, look at partnership liabilities, try to just get the fundamentals. Depending on how timing goes, I would then like to take 20 minutes to half an hour, it depends, we'll see how long it takes, to go through the midterm exams. And then I'd like to begin the next chapter just talking about just trying to get an orientation of partners and the relationship to partnerships. So our objective is to finish chapter 6, go through the midterm, and begin the next chapter. Any questions, issues, concerns? Everyone good? All right. Since you didn't have to study this weekend, anyone do anything interesting before we begin? You got an award?
Yes, for my recognition and loyalty to the line dance group that I'm a part of.
On. You got an award for recognition of what?
And loyalty
To what?
to the line dance group that I'm a part of.
To the line?
Line dance group that I'm a part
Oh,
of.
line dance.
Yeah.
What is line dance? I'll show up my You guys know? Am I the only one who doesn't know?
Well, we line dance to everything, to different songs. Yeah, it's a lot of fun. It's a line dance out there for every song.
And where are you performing?
Well, we have parties every second Friday at Symphony Hall. They have classes every day of the week, just about.
You know, if you told me earlier, the Sunday brunch, we would have hired you guys. Next time, you gotta let me know, Tamara, and forget about getting a guest speaker on psychology. We'll get a line dance, and we could have our very own. Well, congratulations on the loyalty award. Anyone else? No one else? Nothing else? All right, well, again, I sent out an email. If anyone's interested, I will do a little bit more, maybe tonight and one more time next week, pitch for. If you guys are free, not November 3rd, my bad, November 5th, if you're free for brunch, it should be a lot of fun and educational at the same time, consider joining us for brunch, okay, November 5th. All right? Ready to move on? Partnership liabilities, guys? All right, so chapter 6. Now, let's just take a step back before we take a step forward about partnership liabilities. I mentioned this, I'm sure, in chapter 2, but it bears repeating in this larger context. When you make an acquisition, individually, not in a partnership form, where you put down $30,000 to buy a building, and the building costs $100,000, and you borrow $70,000, right, to buy this $100,000 building. We all know what is our basis in the property, right? It is not $30,000, even though we only had a cash outlay of $30,000. It is $100,000. Everyone agree? And you might point to, Evelina, where would you point to as a source of authority? You're whispering.
752.
Well, 752, I'm talking individually, before we get into partnerships, because you just raised the issue about a partnership, and I'm just talking about where would we? Crane, right? We would look at Crane, right? Because the first half of the Crane decision talks about what is the taxpayer's basis, and it doesn't look at just the equity, right? It looks at what the acquisition cost is, Code Section 1012, right? So I would say probably the Code Section 1012 in the Crane decision for the proposition the basis is $100,000. Agreed? So again, you don't just look, right, at a cash outlay when you're determining your basis in a piece of property. Now, the problem is, right, Evelina, that when you acquire property, when I say you, let me be careful about my pronoun use. When a partnership acquires property, right, it might put down $30,000, right? It has $30,000 of, say, Alicia and Annetta each contributed $15,000. Got the visual? So the partnership has $30,000. Now it wishes to acquire a building, right? And the building costs $100,000, and the partnership borrows $70,000, right? The question becomes, Had they done this individually, we know the answer, and everyone here, I hope, would say convincingly that the base is $100,000 and no equivocation in their voice. It becomes much harder conceptually when you apply that to a partnership because there's other dynamics, right, going on. There's a partnership agreement. It's not one person looking in the mirror. It's Alicia and Annetta, and they have worked out their own relationship of how they're going to split their profits and losses, right? And who has exposure and who doesn't. And the role of Code Section 752 and the regulations promulgated thereunder is to help elucidate what should their outside tax basis be. So keep in mind that's this chapter is dedicated to knowing outside tax basis. You know, in Chapter 4, we looked at allocations and we focused primarily on capital accounts, right? To some extent, Chapter 5 as well, we also looked at outside basis. But this chapter, 752, the goal line is, what is the taxpayer's outside tax basis? Now, in part, we're still going to have to look at capital accounts, but do bear that in mind. And in the very simplified example I just gave you, their outside tax basis, and then and Alicia, if the partnership does borrow that $70,000, their outside basis each goes up by $35,000, right? So that they each have a $50,000 outside basis. It would be a $15,000 initial basis, plus under 752, it would each go up by $35,000. Agreed? And again, the goal line of 752 is to mimic, in large part, what would happen if they were joined at the hip and they were twins. What do you call when you have attached twins? Siamese, or when they're attached? Conjoined. Is that it, Sharon?
I think so.
Okay, it's not a good situation medically, so I'm glad you're not joined at the hip. All right. We always talk about all those tough operations where they had to separate the twins, and not easy. All right, so in terms of background, guys, that's really the background behind Code Section 752. This is one, just like the other regulations, where it behooves you to read the regulations. The good news, the authors have been very selective. And also the examples of the regulations. It's very hard for me or any other professor or the textbook authors to vary too far from those examples. So once again, there's not as many here as in Chapter 4. So do yourself a favor, try to read the regulations the authors look at. Now, as we suggested in Chapter 2, it was pivotal to your success to try to isolate is something recourse versus non-recourse, right? It was very important, and it's no exception that in this Chapter 2, you have to do the same exercise. You really have to identify, is it recourse versus non-recourse? Now, with recourse liability, what is fundamental, what is pivotal in terms of you being able to ascertain how to allocate that liability between and among the partners? You're going to say?
Economic risk.
Economic risk, right? And what you do, right, we're going to go through a constructive liquidation, right? What happens if everything goes wrong, right? And all the assets become worthless? Who bears the burden? Who bears the economic burden associated with this constructive liquidation? Okay? And the author's instructor will go through several examples. You have to look at the capital accounts. Okay? You have to look at the capital accounts and see who would end up honing up ultimately if there were obligations to be had. Okay? And again, the authors direct you to situation, and you got to look every which way. Who guaranteed anything? Because if you guarantee something, then that means that you may have to pony up. But in some cases you guarantee it, and that means you got to pay up. But sometimes if you guarantee it, you have what's called a right of subrogation, which means you step into the rights of the creditor, and you can now go after your fellow partners. So all I'm saying is, if you read the examples in the regulations, and we'll see it in our textbook, it can go either way. A guarantee may make you liable, but it may not make you liable. All right? It's going to be very fact specific. I'm sorry, I'm not trying to talk in conundrums here. Do you understand that sometimes a guarantee puts you at risk, and other times the guarantee doesn't, because you have recourse against other people? And if it's the latter, that means that you're not at economic risk. Also, if you put up property as security, that's putting you or your property at risk. That means that you may be able to share in the liability. And why do we care about this? Again, let me just make this point clear in case it gets lost up here as you're too engrossed in this. Is basis a good thing or a bad thing generally? It's a wonderful thing. I like the way you think, Joe. Yes, it's a wonderful thing. So, because basis enables you, if need be, to get depreciation deductions, take losses, all sort of minimize gain. So outside basis is important. So you want to make sure, to the extent you want to secure deductions, that you have adequate outside basis. But you may not want, your limited partners may not want the risk. So there's a weighing process. Now the authors discuss, and we will see what comes to these things. There's new proposed regulations on recourse liabilities. Now, they are proposed. It makes for interesting reading, but for exam purposes, fear not. You're not going to be held accountable to them. I don't know if some of you may or may not have seen that the Treasury Department, over the last week or two, has withdrawn several important regulation projects that were submitted during the Obama administration as a way of, quote unquote, saying to alleviate the burden on small taxpayers. So it's not clear where these promulgated regulations, the status of these and some others are going. So this may be the starting point of something larger on the part of the Treasury Department, but again, just last week, 8 different really significant regulatory projects that were begun during the Obama administration have been withdrawn. So I don't want you guys to spin your wheels on proposed regulations that are still taking shape. For our purposes, for exam purposes, for your client purposes, constructive liquidations are still what will be effective, okay, guys? So bear that in mind. All right, enough said. Recourse liabilities, regulation, which regulation, guys? 752-2, okay? Regulation 752-2 is the operative regulations when it comes to recourse liabilities. Now, with respect to non-recourse liabilities, these are more complicated. I could say they're simple and ignore some of the nuances, but let's just bear in mind they're actually more complicated. There's like a 3-tier layer. Right, Louis? You were going to say, you're nodding in agreement. So talk to us, Louis. if you were describing this to a client, I stepped into your office, you just tell us in general and loudly what or how to handle non-recourse liabilities.
All right, non-recourse liabilities, you don't have to, you're not going to be on the neck for the repayment of these liabilities. So the distribution that goes by, or I should say the allocation goes by either the share of the partnership profits. So if you're 50-50 partners, the liability will go 50-50 divided evenly between you.
Okay, but is that it?
No, there's
I mean, that's almost the default rule, but first you gotta take care of the first two layers.
Partnership minimum gain.
Alicia?
So first, you check if there's partnership minimum gain, and then the next step is building 704C.
All right, so you have a minimum gain akin to the Tufts kind of gain, right? Where you have non-recourse liabilities in excess of adjusted basis, right? So everyone's familiar with the Tufts kind of gain, right? Where you have a liability in excess of adjusted basis, and no matter what you do with that property, if you dispose of it, it will give rise to a gain, that portion. That liability is not shed. Everyone agree? And then, if you recall, 704C gain, right? That's a contributed gain. Also, is going to be allocable to the contributing partner. And the authors on page 196 give you an example of 704C gain in the second full paragraph. And we'll go through an example or two like this. The point is, when it comes to non-recourse liabilities, you have three different tiers. You have the minimum gain, the 704C gain, and then it's allocable in accordance with the partner's profits. In most instances, in many instances, I should say, it's just going to be the third. In other words, many accountants and attorneys, when they hear about non-recourse liabilities, they sort of ignore the other two tiers. You shouldn't, because that's risky. But they just allocate non-recourse liabilities in accordance with partners' profits interests. Okay? So do not worry about, for your purposes, part recourse, part non-recourse. For exam purposes, I'm not going to get into anything that esoteric. If you look at page 198, there's a revenue ruling 95-41. This is a nice example. I don't know if you guys can go through it on your own. I just invite you to, in my margins, I wrote out that you have taxpayer A is contributing property that's appreciated. It's got an adjusted basis of 4, fair market value of 10, subject to a liability of 6. I'm going to repeat again. I just write in my margins, but you guys can do the same. Get the visual of this. A is contributing property with an adjusted basis of 10, fair market value, adjusted basis of 4, fair market value of 10 with a liability of 6. So it has a $2,000 Tufts gain. Everyone agree? And B is contributing $4,000 of cash. Does this make economic sense that they would be 50-50 partners? Sure, because A is contributing property which is subject to a liability of $6,000. It's worth $10,000. So what's he really contributing? property, you know, when you take into account the liability, the property itself is worth $4,000, right? Everyone agree? So economically, this deal makes sense, 50-50 partners. And what the authors of this revenue ruling go through is whether or not there's a minimum gain, if there's a 704C gain, and then how to divvy up the profits percentage. All right, so you guys can read this on your own. It's a pretty detailed example. We'll see how this plays out. The problems that we're going to look at beginning on page 204 take some time, so let's go through these and see if we can finish them before the break, or if not, after the break. So I'm looking at page 204. For exam purposes, guys, you're not worried about tiered partnerships. You guys have enough going on. I would not expect to ask any questions regarding tiered partnerships. So in problem page 204, we have 3 partners, each contribute $20,000 to form ABC General Partnership. The partnership agreement satisfies the primary test for economic effect under 704B. Okay. So we can allocate, right? We meet the substantial economic effect test. The profits and losses are allocated 40% to A, 40% to B, and 20% to C. And that's perfectly permissible. Some people think that percentages have to be allocated based on capital contributions, but that's not true, right? The partners can arrange any way they want it, right? There's no limitations there. The partnership uses $60,000 cash, right? It got three contributions of $20,000 apiece, so it has $60,000 cash at its disposal, and borrows an additional $40,000 on a recourse basis and purchases land for $100,000. Okay? So we agree that if it borrows an additional $40,000 on a recourse basis, not non-recourse, recourse. Okay? So it'd be important if it's recourse versus non-recourse for $100,000. What's the cost basis in the land? $100,000. Okay? At the end of the day, we need to know what are the partners' outside bases. Where are we going to look? We're going to look at what regulation 752-2, right? That deals with recourse liabilities. And just as Luca said before, we're going to have a doomsday scenario. What happens if this building becomes worthless? Right? So we have 3 partners, A, B, and C. What's their original capital account, guys? 20,000, right? Now, if things took a bleak turn here, Jessica, how would we divvy up the losses?
A and B would get a loss of 40,000,
Right?
and C a loss of 20,000.
So, what would this mean? What's the upshot? I mean, given that we now, Alicia, what were you going to say?
So I was gonna say that the practical part is that we have, we split the liabilities between A and B. Each of them will get 20,000.
And what does that mean each of them will get
It
20,000.
means that they will assign the liabilities into the basis, assume the liabilities,
And what basis are you referring to?
outside basis.
We'll go to
Will
what?
Go up.
To what?
From 20 to 40.
Okay, that's the most important thing, because people look at this and they don't connect the dots here. The important thing is taxpayer A and taxpayer B, their outside basis will go from 20,000 up to 40,000. Everyone agree? Their outside basis will increase. And what's our justification? Because in the doomsday scenario, they're each bearing $20,000 in liability. Everyone agree? Because there's no limitations here. If the building becomes worthless, they would each be out $20,000. The regulations. Now again, the promulgated regulations take issue, and they might change this outcome. For exam purposes, this is the right answer, that their outside basis would be 40. You might say, well, do you have examples? Do you have authority for that? Sure. If you look at I told you again, the regulations here, the examples are pretty easy to follow. This is regulation 752-2F, examples 1 and 2. I'll repeat. 752-2F, examples 1 and 2. I'm sorry?
Is the law, so if you're saying they have the recourse, their basis will increase by 20?
Yeah, their outside basis, right, starts off at 20,000, what's majority? Code section 722, right, outside basis. But then as a result of 752, their outside basis goes to 40,000 apiece, right? Agreed? Yolanda, you got that? All right.
Can you just clarify why A and B split the liability and then C doesn't get anything? I'm not clear.
When you say C doesn't, because C has no economic risk of loss.
Okay,
And that's what these regulations turn on, rightfully or wrongfully for now. All right?
So then their ending basis, then technically it's just 0.
I'm sorry?
Their ending basis for A and B isn't it 0?
Why do you say it's 0? Their ending basis is 40 each. Why do you say it's 0?
Because you're taking 40, allocating 40 off.
I'm not doing anything. This is just a hypothetical, right? If things go bad. This is their capital account, right? Ashley, this is not their outside basis. This is a bridge to help you determine their outside basis, guys. This is a means to an end. This is not the end. The regulations say go through a constructive liquidation. And by going through this exercise, Ashley, we can therefore determine outside basis. Okay? Agreed? But this is not what's really happening. Let's hope the building doesn't become worthless. We don't, we're not going to be paid our fee if the building becomes worthless, right, guys? So let's keep our fingers crossed. But in the meantime, we got to allocate outside basis. We're good? I mean, you got to understand this before we progress. Question B. What results in A above if A, B, and C contributed 10,000, 20,000, and 30,000? Don't say it out loud. Work it out behind your desk and come out. Pretend it's December 6th. Oh, wait, is that D-Day? What day is D-Day? It's the 7th? 7th, oops. Oh, pretend it's exam day. My exam would say, in this question, what is the taxpayer's outside basis? So pretend for a moment it's exam, and this is the question, and I asked you, what is the partner's outside basis? So go figure it out. Don't say, Eman, hold your question. I think you're in the question. Just hold your question. Figure this out. So either Andrew, you guys have answers of what outside basis for A, B, and C? Andrew?
Not sure. I have A is 35, B is 35, and C is 30.
Yeah. Andrew, do you agree? Disagree?
I said disagree, but I don't know why.
Sure. Adrian, do you know?
40, 30, 30.
40, 30, 30. Okay, Jessica?
I have the same loss allocation, 40, 40, and 20.
Oh, don't say loss. My exam question wouldn't say what is the loss allocation. My exam would be the practical question of what is the outside basis. So Jessica?
Oh, outside bases, I have 34, 36,
34, 36 what?
10.
10. Well, talk to us, Jessica, how you got the numbers. Let me just listen to you. We all agree, right? Let's do the A, B, and C. What is their initial capital accounts? Because let's walk on the bridge together, right? This is the bridge to the end. So what's their initial capital account, Jessica?
A is 10,000,
Yep.
B 20,000, C 30,000.
Okay, everyone agree? Now, bad things happen, right? The building becomes worthless. How are we going to divvy up the loss?
44,
4,
20.
20.
Everyone agree that if things go bad, this is what's going to happen. Agreed? And how would this happen is because these folks would have to kick in 50,000, everyone agree? 10,000 of which would go to C, 40,000 to the bank, right? That's where the numbers come in. Everyone agree? Now, what about the liability here? Because the liability is 40,000, right? The recourse, and we have to divvy up the 40,000 recourse. And we'd have to, what's the total obligation they have is 50, right? So it would be 30 over 50 times the 40, which is how much? 24. And 20 over 50 times 40, which is 16, right? So that's the burden that they're each bearing with respect to the recourse liability. So you were saying, Jessica, I think, A's outside basis would therefore be 34. I wrote down an incorrect number myself. 34 B's would be
36, and C would be 30.
36.
And C would be 30.
I'm sorry?
What is the 50?
I'm sorry.
Where is the 50
The 50 is the total debt that they owe, 30 plus 20. And we have to take that proportionally. The debt is 40, but we have to figure out what proportion of this debt they owe to the bank, and what proportion of the debt do they owe to the other shareholder. Question C. So everyone's got this? Question B?
What's the basis for C?
Well, C's basis is going to be whatever they contribute. They don't get any portion of the recourse liability. So again, the answer here is 34. A's outside basis is 34. B's outside basis is 20 plus 16 or 36. And C's is 30. Adds up to 100, right? Oceana, you got that? All we're trying to do is replicate to some extent if this were an individual, right? It just becomes harder when you have multiple parties. But we know the answer's got to be an outside basis of 100. It should total here 100. Question C. What results in A above if A and B are limited partners who are not obligated to restore a deficit capital account, but the partnership agreement includes a qualified income offset? So A and B are now limited partners. I forget if this refers to the first question, right? What would happen in this case? I'll do a new one here. A, B, and C. They each contribute 20. A and B are both limited partners. C is a general partner. Don't say it out loud. Take 1 minute. Tell me what the outside basis is. So, Doris and Angie, what do you guys say it is? Sure? Doris? Lisa? Outside basis here. Audrey? And Evan? What do you guys say it is?
The question is it recourse or not recourse?
It's recourse. Question C is recourse. But A and B are limited partners. So I want to know the outside basis for each.
I would say 20, 40, and 60.
20, 20, and 60. Evan, agree or disagree?
I would say 40.
What do you say?
Since they're limited partners, for their capital accounts, can they not go below 0?
They cannot go below 0. Everyone agree? A and B cannot go below 0. Qualified income offset only means that if they accidentally go below 0, you got to get them back to 0 as quickly as possible. But you can't do it purposefully, right? So if things go bad and the building becomes worthless, we're limited to $20,000 a piece, right? Everyone agree? That's the maximum. What about the other 60? Has to be allocated to C, right? So therefore, A's outside basis is going to be 20, going to stay the same. B's outside basis is going to stay 20. C's outside basis is going to go from 20 up to 60, just like Andre mentioned, right?
There was no qualified income offset for C.
Even if there was no qualified income offset, it doesn't matter. But I'm not sure if I answered your question. I mean, qualified income offset doesn't get anyone an inch closer here. Doesn't get the limited partners any basis.
I always thought that qualified income offset removes any negative balance.
Qualified income offset does what?
That removes any negative balances.
No, it doesn't. I mean, qualified income offset, the only thing it does is it says you can't, even though you don't meet the big three, remember the big three, the third test says if you have a deficit in your capital account, you got to make it up. And limited partners don't want to hear that, right? The qualified income offset simply says if you accidentally go negative, allocate income back to that person as quickly as possible. That's all it says. All right, so in this one, guys, everyone has this? Everyone knows the outside basis, right? This is recourse liabilities. Question D. What results in C above if A contributes $15,000 to stocks to the partnership as security for liability, and all income gain or loss in the stock is allocated to A? What result if A contributes his $15,000 note? So there's different. Let's just first take the stock.
This is in addition to the $20,000 or instead of?
This is in addition to. Okay, so he's going to contribute this as security. So figure it out, guys. Take about 2 minutes and try to figure out what the tax basis here. A, B, and C. have some numbers they want to throw out here? Mohammed, you have a number there? A, B, and C?
Not yet.
You not sure?
I have 35 for C, 20 for B,
So you have 35 for C,
20 for B, and 60 for A.
60.
I think that's what.
Remember, we shouldn't exceed 100 here, right?
Okay, so then we'll just take off.
Remember, again, guys, the way to check yourself on this.
It would be 40. 45.
Rafael, you agree?
Too sure.
David? I'm sorry?
Don't have my phone.
All right, the book, okay.
Did you just write it down the way you said it, or did you write it down back?
I think I wrote it down the way you said, 45, 20, 35 is outside basis. What's the starting point here? 20, 20, and 20, right? Everybody agree? Now, the agreement calls for partnership allocations, right? They want to split it 40, 40, and 20, right? That's the losses. We're supposed to be split 40, 40, 20, but in this particular case, can we give a full $40,000 worth of losses here? And the answer is no, right? Because he can only dip to negative 15, right? Because he gave security up to 15, right? He can go negative up to 15. B cannot go negative at all, right? He didn't give any security. And then that leaves C shouldering the burden. So, you do the arithmetic,
I have a question.
this should be, Mohammed, is that what you meant, 35?
Yeah.
Maybe I misheard you. These numbers are the outside tax bases. Go ahead, Alicia.
So, for A, you put only $20. What about the 15 that he,
But it's not clear if he made a capital contribution here, because it says he's holding this out as security, right? He's saying, look at the way the question is framed.
he contributes the stock to the partnership
I mean, you could,
security.
if he contribute, I don't know what his tax basis is in the stock, remember, okay? You're right, his capital count would go up if you contribute stock, okay? Everyone hear me. We don't know what his tax basis is on the stock contribution, agreed? We need to know more information, the authors aren't telling us. For my purposes, guys, and by the way, there's regulation directly on point on this. 752-2, regulation 752-2H2 and 3. I'll repeat. Regulation 752-2H2 and 3 for the proposition of this, that if you put up security, you can be allocated that amount of the loss.
Sorry, is it on the regulation?
752-2H2 and 3. 752-2H2 and 3. But you're right, Alicia, this would increase the capital count for utility capital contribution.
Excuse me. If we take into consideration the 15,000, it means the allocation is going to change.
I'm sorry?
I mean, if we already put the 15 added to his capital as already kind of contributed,
Right.
it's going to change sometimes, the numbers.
Well, okay, so what you're saying is, if we made the capital count 35, let's just lay it out
It's
here.
the same result, end result.
Right, yeah.
The end result is the same.
Okay?
But the result's the same.
And the result should be the same.
Right,
It
yes,
doesn't
yeah,
matter. Benny, the outcome will be the same if you increase capital count or you don't. It's just, he's gonna be at risk for 15 more thousand. And that's what remember, the whole premise of regulation 752-2 is who's holding the liability at the end of the day. And if you put yourself out there and expose yourself with 15,000, well, guess what? That's gonna be your burden. All right. And whether or not you contribute property or contribute a promissory note, the outcome's going to be the same. Okay, so when the authors say, would it make any difference if he contributes a $15,000 note? One thing's for sure: if you contribute a note, does that increase your capital count? And the answer is no. Okay, if you contribute a note, that will not increase your capital count. And this gets back to regulations we looked at in Chapter 2. Regulation, Benny, you ready for this? 704-1B2, 4 little i's, D2. I'll repeat. 704-1B2, 4 little i's, D2. The capital count will not be adjusted as a result of contributing a promissory note.
Yeah, but this is outside basis now.
These numbers here are capital count. This is outside basis.
So then what's the outside basis with the note?
What's your question?
What would the outside basis?
The same outcome.
Same.
A would have an outside basis of 35, B 20, C 45.
So the first question was more like what you were about to write out, I think. And the second one is like what you initially wrote out.
I'm not sure, Andrew.
Okay.
So what is the 0025?
I'm sorry?
What is the 0025?
What is the...
Negative. The negative 15, 025.
This is the capital count.
Okay.
That if everything became worthless, A would have to pay the bank 15, right? He put himself on the risk. B's the limited partner, had no risk. And C would have to pony up 25,000, and that's how the liability is going to be split.
The first rule is the initial contribution. The
Right.
second one is the
Yeah.
outside basis. The third
No.
one.
This is all capital count. It has nothing to, remember, this whole exercise is to get us a bridge to figuring out what is the person's outside basis, but this is all capital count computations. Amen. And once we figure this out, we know the outside basis starts at what? 20, 20, 20, right? And then we allocate the liability based on who has to pony up. That's how the regulations under 752-2, how do they do it? They go through this capital count exercise. So the outside basis is 20 plus 15, 20 plus 0, 20 plus 25 is the outside basis. Okay? But do not confuse this. This is not outside basis. This is a bridge to get you to the outside basis. Question E. What result in C if A personally guarantees the $40,000 liability? Don't say it out loud. Let's go back to question C. I think this was question C. remember, E-Man, the exam question is, what are their outside bases? Okay, that's the, I don't want to know how you got there. I do, but, and that's important. But for exam purposes, I would just simply ask, what is their outside tax basis, right? So Luke, what do you say it is?
60, 20, 20.
60, 20, 20. Maria, agree or disagree?
I agree.
Nick? Hey,
40, 20,
40, 20, 40.
A person guarantees the loan, isn't she responsible?
All right, so Tamara says A guaranteed, right? That seems like A is going to be left. You know, things go bad. Last I checked, guarantors, suffer the consequences, right? So let's just take scenario one. Things go bad. The bank comes knocking. Mr. A, we have your guarantee here. Pony up. You owe us the 40. The building's worthless. It's worse than worthless. There's environment. It's underwater, literally and figuratively. And it's global warming. There is no more building. It's all underwater. It's become Atlantis. But last we checked, we can't get tenants into Atlantis. All right. That being the case, what are we going to do?
Find a mermaid.
Find a mermaid. Okay. I think aren't they building in Dubai an underground a city underwater?
Something like that. Or a hotel.
Something like that. But until that happens here, that's not our case. So A, you owe us the $40,000, and guess what? If that's true, we know the answer here. This is going to be minus 60 E-man. This is for capital account purposes. This will be negative 40, right? And this, I tend to be fancy about this. This will be negative 60. This will be negative 40, right? And this will just be negative 20 because, if the building became worthless, A would have an outside basis of 60, right? 20 plus the 40. Agreed? And there's a regulation on, there's a regulatory site on this, Diana, 1 second. It's 752-2B3, one little I. I'll repeat. 752-2B3, one little I. Okay? Regulatory site. Allocate the loss to A. But the regulations continue.
So which one is, so A get the 60 loss,
When you say 60 lost,
just the loss, how is the loss?
is that he's going to have to pony up. Yeah, he's going to be, how do I say this? Hold on. Let's just, we're back to C. They're, A and B are limited partners. It's back to A. And the losses are allocated 40, 40, and 20. But the thing is that A is guaranteeing this. So A ultimately is holding the bag and will suffer the $40,000 loss because he's the one who's guaranteeing it and it's his obligation, right?
So he's gonna get the loss.
B can't go negative. C only gets 20,000. So all the other loss has to, in terms of going negative, has to fall on A's shoulders.
Why outside basis for A is 60? Why not 40 only?
Because A initially contributed 20, that's his starting, plus he has a liability under 752 752 of 40. Okay, it's recourse liability. Diana, you had a question.
Yes, I think we got an answer already. Just so the reason why we can go up to 40,000 negative is because he was responsible for that.
He's responsible for the entire liability.
Would there be a situation where he,
Hold on, let me just give a site and then, so the answer here, if A is left holding the bag, is 752-2B3, one little y. But there are some guarantees in which taxpayer A guarantees but has what's called a right of subrogation, where he now steps into the creditor's shoes and he can then go after the partnership. And guess who, if he goes after the partnership, who can he go after?
general
C, the general partner. Or C, if he has a right of subrogation, guess what? The liability is not allocated to him, it's allocated to C because C is the one who will bear this obligation. Okay? And authority for this proposition is found in the regulations 752-2B3, 3 little i's. I'll repeat. 752-2B3, 3 little i's. And if you want more proof, 752-2F, example 4. I'll repeat. 752-2, example 4. And example 4 goes both ways, if I recall correctly, where it says in one case the person has no right of subrogation and therefore the liability is allocated to the person, and conversely, where there is a right of subrogation and therefore the allocation is not to that person. Kelly? In which case? Absolutely, because C is left holding the entire responsibility. Diana?
Can you go, so for A, we try to go after the partner. Is it just because he's a limited partner, so he shouldn't really go negative? Or
Well, B can't go negative, right? He can't go against B. Legally, he has no recourse against B because B is a limited partner. He has no obligation to go, restore deficit capital account.
But does A have to be a limited partner to be able to go after C, or could it be just?
No. In other words, it doesn't matter because it depends on the state law. If the guarantee and the partnership agreement, does the partnership agreement provide a right of subrogation where A has recourse against the general partners? Jonathan?
If A was also a general partner, would it be essentially split 50-50?
Jonathan says, what if A was general partner? There might be joint and several liabilities, so probably would be split in that case, Jonathan. Okay. We need to know more facts there. Okay, so what's your takeaway for your notes with respect to question 1? Again, you've got to go through, E-Man, this is important. This is not the end. These numbers are not the end. This is not the answer I would ask on an exam. Do not give me these numbers. I would ask the goal line because the client doesn't, the client's goal is my goal. What is the tax basis of each partner? That's the objective here. And with recourse liabilities, it's a matter of allocating in a doomsday scenario who would bear the burden. And going through this exercise, we can figure that out. We're about to embark on a very different exercise with respect to non-recourse allocations, or non-recourse liabilities. Okay, so recourse everyone has. And if you're a little fuzzy, look at the regulations under 752-2. Question 2. G&L form a limited partnership. The general partner contributes $10,000, and L, the limited partner, contributes $90,000. The partnership purchases a building on leased land, paying $100,000 cash, right? That makes sense. And borrowing $900,000 on a non-recourse basis from a commercial lender. So you're buying a building for $1 million. If this were an individual, akin to Crane, game over, right? We just simply say the basis was $1 million, go search in 1012, Crane, and call it a night. But this is partnerships, and 752 presents challenges when it comes to non-recourse liabilities. Okay? The terms of the loan require that the payment of market rate interest and no principal for the first 10 years, so it's a balloon mortgage. Assume that for convenience that the building is depreciable at the rate of $50,000 per year for 20 years. Everyone can, and again, we're simplifying it, but it's assuming straight line depreciation. Usually commercial buildings are 39 years under Code Section 168, but here, simplifying assumption. And we're ignoring the mid-month convention. The partnership agreement contains a qualified income offset. Okay, not going to make or break for us. And G is required to make up any capital account deficit. Except as otherwise required by the minimum gain chargeback provision, the agreement allocates profits and losses 90% to L and 10% to G, until such time as the partnership recognizes items of income and gain that exceed items of deduction and loss that have been recognized over its life. Okay, so there'll be a switchover. Subsequent partnership income and losses are allocated equally between G and L. So at some point it's going to go 50-50. Assuming that it is reasonably anticipated that equal allocations will begin after 10 years, but who knows? The partnership agreement states that G and L have 50-50% interest under 752. So the agreement actually is explicit that for 752 purposes, that they're going to split profits 50-50. Okay? Don't say it out loud. Everyone come up with a numerical computation of question A and then question B of what you think how the liability should be allocated. All right. So initially, how is the $900,000 liability to be allocated between the two partners in year one? Say again, Tamara? Equally, right? Because there's no minimum gain, everyone agree? And generally the default rule is what? Based on profits, right? We allocate it based on profits. Profits are, for 752 purposes, 50-50. How much is the liability? 900,000. 50% of 900,000 is 450, and each would increase their tax basis from 10,000 to 460, or 90 to 540, right?
You would want basis at the beginning of the year?
It doesn't, beginning, and then we would do depreciation and we would look at it at the end. We'd allocate, then once we know the outside basis, right?
Okay, you're saying before they actually take any.
Let's even take it right before they take depreciation deductions. The purpose of question A is just to send a message out there. The message is under 752-3. Now we're under 752-3, not -2, right? -3. In this case, A3 is the default one, right? It's just allocated in accordance with profits. Okay? Now, what's going to happen in year 3? How is that $50,000 of depreciation deductions? Remember, how are losses divided initially? 90-10, right? And who's getting the 90, who's getting the 10? L's getting 90. And of this deduction, this $50,000 deduction, everyone get it in year 3? In year 3, there's $50,000 depreciation deduction. How's that going to be split between the parties?
90.
45/5, right? 90% of 50,000 is 45,000, right? 10% is 5,000. So let me pause. Everyone see that? That when it comes to deductions for depreciation in year 3, it's going to be allocable 45 to L, 5,000 to G, right? In other words, each year, year 1, depreciation deductions, right? Year 2, right? Everyone agree? Every year, these are depreciation deductions. And these are capital accounts. You might say, how can L go negative? Right? Because we met the big 3, right? And we have a qualified income offset. How can L be negative? Say again, Louis? There's a minimum gain chargeback, right? Everyone agree? That's how L can go negative. Agreed? Because there's, right, Benny? There's a minimum gain chargeback.
Question. I'm kind of lost because the treatment for question 1 is different from question 2 treatment.
Well, question 1, we looked at the very beginning of the year. We just said how's the liability going to be allocated, right?
Okay.
It's just based on profits, 50-50. We haven't allocated, right now we're just going through the exercise of taking depreciation deductions, right?
But the A part of the question you already answered, right?
Yeah. What's your question?
And how was it allocated, the liability? 50-50?
50-50. $450,000 each.
That's not how we did question 1 though. We did the...
But question 1 is recourse liabilities. This is non-recourse. Benny, you're getting me nervous.
Wake up.
All right.
Sorry.
During the break, get some coffee. All right? All right? And notice, and I don't mean this badly, Benny, this would not be, if this were the final exam, this would not be good. All right? So for final exam, guys, bring that red pen, do whatever, drink whatever you need to, but make sure you distinguish between recourse versus non-recourse. Notice the rules are wholly different. All right. Now, given this, the question, we still haven't gotten into the question. The question is, how will the liability be allocated at the end of year 3? Now we get into our tiered method. We have to look at the minimum gain as a tier, right? Everyone agree? We have a tier. Now the minimum gain. And that's going to be allocated 5,000 and 45,000, right? That's the minimum gain, right? The tough slide gain.
G still has a minimum gain, even though he's a general partner. He have the,
Absolutely has a minimum gain.
even though he has to restore the deficit.
He does, I mean, he does too, but they're each going to be charged back, right? It's a chargeback based on the depreciation deductions. So G would be tagged for 5, L would be tagged for 45 if they walked away from this property. Liability is 900, right? The adjusted basis is 850. There's $50,000 of gain embedded in this property. So this is the first tier of minimum gain, right? What is that total? 50,000. How much liability is still left? 850, right? We counted for 50, and now we have 850. How is that going to be divided up? 50-50. So now So now the total liability, this is allocated 430, this gets allocated 470. It gets funky. You're reallocating the liability. This is the profits interest, or the excess.
Why are we pulling?
So we're in year 3, this is happening in year 3?
This is happening in year 3.
Why are we allocating
Now, as a practical matter, this becomes a Herculean task, and the regulations actually say, how should we allocate this $900,000 liability over the long term? Because who's going to need the deductions here? Who's going to need the deductions? G or L? L, right? So what the regulations suggest that get done here is that on day 1, I'm just telling you what the regulations, because you can go through this exercise. What's going to happen? The minimum gain is going to get larger and larger and larger. Everyone agree? And the excess is going to get smaller and smaller and smaller. Everyone agree? And if you play this out over a 20-year period, what's going to happen?
That's gonna have 900,000.
L is going to get 900,000. Well, it's going to get 810.
Sorry, yeah,
And G is going to get 90. And if he's, in other words, you want to give L plenty of outside basis so that over the next 20 years, L can deduct, right, 90% of the purchase price, right? The purchase price here is $1 million. 90% of that, right, is 900,000. So if we allocate to L, ultimately 810, and we allocate to G 90, the regulations permit you to do that, to say take into account your projected allocations, because so that if you wanted to say L has a starting basis of 900, G has a starting basis of 100, the regulations are okay with that because that's anticipatory of what's going to happen, the fate here. You can play it out here, it's a pain in the neck. Because each year, the tier system says take into account the minimum gain. And Benny, you'll need your coffee to really absorb this. Or this weekend. Seriously, this is, but my point is, if you look at this is a very small chapter, guys, for our reading. But they say what you're trying to do is give outside basis to the partners who need it, right? Because if they don't have adequate outside basis, put aside the at-risk rules, put aside the passive activity loss rules. 704D, right, limits deductions, right, are limited to your outside basis. And there's no reason for the code to do that here. So the code and the regulations, should say more specifically, permit this sort of allocation. So for your notes, the answer is in year 3. Let me just say for your notes, two responses. For your notes, the allocation of the liability is 430 and 470. Okay, that's for your notes. But on an exam, you could also point out, and this one for some of you, if you haven't been able to absorb, think about this, and we can talk. Shoot me an email if you don't get it. Is that ultimately, if you want to fast forward this, you could allocate that $900,000 of liability, 90,000 to G, 810 to L, because that's the anticipated way in which they're going to share the future deductions. Kelly.
Wouldn't that L as limited partner be in the first year, wouldn't they be taking on the economic burden, which is the big
How are they taking on the economic burden? Because it's really all going to be caught up in the minimum gain, right? The minimum gain ultimately here, if they keep depreciating, the minimum gain will be 900,000 because they'll depreciate the building down to 0. There's no hanky-panky going on here.
So the second part of the question is, what's the final outside basis? So what's their outside basis after all said and done?
Well, you take whatever their allocation to this liability is, plus whatever their original contribution is, minus whatever depreciation deductions they took.
So they're both gonna have 425?
I don't know what I mean, the question I think is what
Question
is.
is for both. They ask for the allocation of liabilities and then their
This is
final
the allocation. I haven't figured out the outside basis. But I'm telling you how to get there. It's not that hard. You just let's just take this together. Is in year 3, if I do my arithmetic, would be 90 plus 470, right? Would be 540, okay? 540, let me just, before I put it in my mouth, 540 plus 430. Okay, for G, it would be 440 minus 15. 430 minus 15, so his outside basis would be 415. And, 440, I'm sorry, 440, yes, minus 15. And this would be 560 minus 45 minus 45 minus 45. To answer your question. Check me on that.
Yeah, I just wanted to make sure what I was thinking was right.
All right. Okay. So let's look at question D. Let's finish this up and then we'll take a break, guys. Question D. C? Did we not do? Okay. Question C. Where's question C? How will the liability be allocated at the end of years 1 and 3 if the excess non-recourse liabilities are allocated in a ratio of 90% to L and 10% to G? And what this is saying, again, guys, is that, akin to what I was just saying, is that you could take the liabilities. Your answer to question D, or question C, I keep jumping ahead, is you could simply say, in anticipation of future deductions, that the liabilities will be allocated 810 to L, 90,000 to G. Okay? The regulations permit this under 752-3. And if you do that again, the starting outside basis for L, to answer your question, would be 900,000, and for G, it would be 100,000. And does that make sense, guys? Again, it should, because if this were an individual purchasing a building, we know their outside basis, or their basis in the property would be $1 million. G and L as a whole should have an outside basis with a liability of, here's the 900,000, plus they each, G contributed 10, L contributed 90,000 cash. There's the extra 100, that totals $1 million. So your answer to question C is, again, just allocating 90 to G up front, 810 to L up front, and not go through this whole exercise of minimum gain.
I even put in chapter 2, when you distributing property or taking with non-recourse, you allocating your non-recourse based on percentage of ownership.
Be careful what you say, man. It's not, we didn't look at distributions of property. We only contributed, we did not make distributions. Distributions we'll cover in a later chapter. Hold your thought on that. We're going to deal with distributions later as a different topic. Let's look at question A. D. I keep skipping one. Question D. What results in A if the debt is guaranteed by G, who has no right to reimbursement from the partnership? Okay? Does the result change if G has a right to reimbursement from the partnership? What if G has a gross assets of only $6,000? So if G guarantees this arrangement, if G guarantees this arrangement, is this a non-recourse arrangement, right, Benny? This is getting back to recourse versus non-recourse, right? This is non-recourse anymore. The answer is not non-recourse, right? It is then going to be recourse, okay? So if G has the economic risk of loss, we're back to the first question. What's my authority for that? 752-2B. And if that's the case, who gets the outside basis here?
This is gonna be 10,990. 990,000 would help.
Why? What do we look at? It's what happens if this is recourse as to G? G, E-man, this is recourse as to G. G is suffering. So G's outside basis goes up by 900,000. Everyone agree? Because we look at the economic risk of loss. So here, G's outside basis goes up by 900,000. Agreed? Critical. What happens if G has a right to reimbursement? Busto, this is your question.
It's not obligated.
So does his outside basis goes up or not? No? If G has recourse against the partnership, who's he going to go after?
Oh, you saying he has reimbursement?
Let's suppose he has a right to reimbursement. Who's he going to go after?
His own damn self.
His own damn self. Therefore, that should not turn the outcome. The outcome should be the same here, right? This is not the limited partner now able to subrogate and go against the GP. If the GP is the only one who can go after the GP, it's the partner chasing his or her tail.
So he still bears a risk and still gets the liability.
He still gets the allocation, liability allocation.
Could you quickly write out those reports?
I'm sorry?
Could you quickly write, with the capital account, you would just basically increase the outside basis by the same amount of their capital accounts, 10 and 19?
Well, in this case, I would say what happens if the building went worthless, right? They start off with a 10 and 90, but now the building becomes worthless, and L can only go down by 90, right? And G can go down by the $910,000. So he's stuck with a negative $900,000 capital account.
Okay, and then
That's therefore we prove that his basis should go up by 900,000. We're just back to problem 1. Now, the third part of question D says, what happens if G only had $6,000 worth of assets? In that case, you got to see if there's something else going on, if there's some sort of abuse. There's a regulation 752-2B6. That regulation 752-2B6 says this is okay unless there is some sort of abuse here, some reason that they were trying to circumvent obligations. So generally we don't look at net worth. Question E. What result in A above if the debt is guaranteed by L and L has a right to reimbursement from the partnership? So if the debt is guaranteed by L, does L yeah, I mean here if it has the right of if he has the right of reimbursement, then it's truly still G's obligation. G, it's recourse as the G. L would not share in the liability. regulation 752-2B3, one little I. I'll repeat, 752-2B3, one little I. It becomes recourse as to G. What happens if G is the lender? In A, what happens if G is the lender? So it says non-recourse, but G actually lends the money. Is it recourse or non-recourse? What do you guys think? Is it recourse or non-recourse? Amber, you were going to say? Was that you saying? Is it recourse or non-recourse? I thought I heard you. Recourse, non-recourse? Hey, I'm not going to say it's de minimis, because remember, it's 900,000. Last I checked, at least for me, that's not de minimis. It would be recourse as to G. In other words, if G lends the money, you can't call it a non-recourse liability. This is under 752-2C1. I'll repeat, 752-2C1. Listen, I want to make sure if people want coffee, that you can get downstairs by 8. Hear me on this one. This is going to be complicated. If you could, grab your coffee, grab a drink, stop in the bathroom, come back in 8 minutes, and here's the really complicated part. You're going to get, hopefully, to meet your neighbor. Can people line up, introduce yourself alphabetically outside so I can distribute your midterms? I have it alphabetically, so my last name, guys. So can everyone get ready to introduce yourselves and figure where you are in the alphabet? Okay, I'll see you back here in about 10 minutes. Outside in front of the door. Flow through this and then finish up this chapter and talk a little bit about the next chapter. In terms of material, let me just turn off my phone because then it will go off. I apologize. Look, the exam, you guys have heard me say this in income tax. If you did well, don't rest on your laurels because the final exam is more heavily counted. If you didn't do as well as you would like, there's opportunities to do better. I say, try, if you haven't done as well, buy the used edition of those test banks and test yourself, all right? Because it's hard to go back through the material we've gone through. It's easy to say, you know it, and just flip pages because you've gone through it. But try new material. If you have problems finding these earlier editions of other test banks, let me know. I'll shoot you an email, and off Amazon, you can pick it up for $4 plus shipping. Okay, but now is the time to do it. Not at Thanksgiving, guys. Okay, unless you like paying more for shipping. All right. So do me a favor, and if you go through it and you have questions, let me know. I will say this. You may not agree. I tried. I'm not always. I'm not sure. My objective is to try on a scale of 1 to 10 to keep the exam level at a 2, 3, at tops of 4. I don't, some professors, really I know this by having lunch with my brethren professors, they say, oh, I like to ask a 9 or 10 so students are just thankful if they get anything, they're happy. That's not my approach. That doesn't make my day. My day is made more if you guys succeed and can handle the straightforward questions. So on the final, it's going to be very similar, basic questions. So the first question is a 751 question. You contribute this property. And we want to know, does the partners have gain or loss? Everyone here should get 100% on this. There's no reason, question 1, anyone should have gotten A or B wrong. There's no gain or loss to either A or B. They're outside basis, you just have the total. So A should have 140 outside basis, B should have 20. That's as straightforward as it gets. The partnership's adjusted basis in the securities is a carryover basis of 40. The holding period, if you recall, you get a tacked holding period if it's a 1231 asset or capital asset. Your holding period is not tacked, it's anything else. So in A's case, half should be tacked, half not tacked, right? Because securities are capital, cash is not. Taxpayer B, the partnership's adjusted basis in the goodwill is 0, just carry forward. And the holding period, again, if you do the arithmetic, if you add up the land, the building, and the goodwill are all capital assets, that's 100. The accounts receivable is not, so it should be 50-50 again, in terms of holding periods. So, I like to think, again, everyone here should have gotten easily 8 points for starters. All right? Suppose the building B contributes is subject to a recourse mortgage of $50,000. Not non-recourse, non-recourse. Excuse me, recourse, not non-recourse. $50,000. And in this case, does A and B have any gain? Now, in this case, they're 50-50 partners, so B is shedding $25,000 of liability. Neither A has no gain, but A's outside basis has to go up, right? From 140, it's going to absorb $25,000 more of liability. We did this in Chapter 2. So his outside basis goes 140 plus 25. B is considered as if B shed $25,000 of liability, must recognize $5,000 of gain, and the outside basis is reduced down to 0. I mean, stop me if you guys think, boy, that's unfair for you to ask that. Suppose it's a liability of only $10,000. Well, very similar analysis. But this time, A's basis is outside basis is only going to go up by 5, and B has no gain or loss, and the outside basis, right, is going to go down by $5,000. He's shedding $5,000 of liability. Right? Just make sure people read Chapter 2. That's all. I'm sorry? I'm not sure. I don't hear the question.
The third question is no gain loss and A's outside base.
It's 145. Okay. Question 4. Suppose the land B contributed is sold for $40,000. Right. This deals with issues that we dealt with just a week or two ago. And if you contribute property, right? In B's case, B contributed property with a book value of 30, with an adjusted basis of 10. Everyone agree? And now it's being sold for 40, right? So there's a book gain of how much? 10. Everyone agree? They contributed it when it was worth 30, but now it's gone up from 30 to 40, and both partners want to share in that, right? In that growth. So in that case, how is that gain going to be split? Well, the non-contributing partner, namely A, should get 5, right? And who's going to bear the entire rest of the gain? The contributing partner has to bear the onus, right, of that built-in gain, right? They contributed property with a $20,000 built-in gain, so they should have to bear that burden. And we did several problems like this, guys. Everyone here should get this right. Amber?
So the gain is 20?
The gain is 20, but plus 5.
Okay.
25.
Yeah.
All right? And I'll repeat again, I'm sorry if I wasn't original with any of these problems. Sorry if they were boring. I mean, they're just straight, just changing in my part, changing a few numbers from the problems we did during class. Suppose the property is contributed, the contributed property is sold for 25. This time, there's going to be a loss on the property. Excuse me, there's a gain on the property. There's a book loss, right? There's a book loss, but under the traditional method, A can't get that loss, so can't recognize it because it's under the traditional method. And for tax purposes, there's going to be a $15,000 gain, right? If the property were sold for 25. B's the one who brought that property to the party, right? B has to suffer the consequences for bringing that property to the party. Suppose B contributed land, the land contributed is sold for $30,000. Well, just to emphasize that again, there's no book gain. If there's no book gain, the non-contributing partner doesn't report anything, but the contributing partner has to shoulder the burden of the $20,000 gain. What was that? I hear someone talk, but I can't hear. Well, the gain is going to be allocated entirely to B. He's the one who brought the party, the property to the party. With a $20,000 gain, he should suffer the consequences. So the answer to question 6 is A, 0 gain, B, 20.
What's 5B?
15.
That's what I have in the exit.
If I put the word set, that means it's okay. Okay? Question 7. Question 7 and 8 just deals with what is the appropriate tax year. And in the first, J Corp has a 70% interest. We have 3 different players form a corporation. J Corp has a 70% interest, and each of the other partners have a 15% interest. If its taxable year ends March 31st, we have to go with the, what do they call it, the majority owner. So the answer, most of you got this, was March 31st, which makes sense because that's what the statute says. If you look at question 8, we don't have time tonight. Anyone has a problem? Question 8 just looks at what's the least aggregate deferral. This was a little bit time consuming, but you have to do 3 trial and errors and figure out which would result in, it's not the first rule of the majority, it's not the principal, it's the least aggregate deferral, and the answer here is September 30. Again, look at the regulations, apply them, and that's how you would get September 30. Question 9. A and B form 50-50 partnership on January 1st of year 1. Each makes a cash contribution to the partnership of $100,000. The partnership purchases depreciable property or depreciable equipment for $200,000. Partnership agreement meets the big 3, provides that all income and losses are allocated equally, except the depreciation deductions are allocated to A. Sound familiar, guys? Assume the equipment generates depreciation deductions of $50,000 per year, and then in all years the partnership breaks even, except for depreciation deductions, so it incurs a loss each year of $50,000. On January 1st of year 3, the equipment is sold for $180. State how the gain should be allocated and compute the partner's capital accounts immediately after the sale. So I wasn't looking for anything fancy here. All I was looking for, guys, is what is their beginning capital accounts? 100,000 each, right? And let's just take the property starts with a $200,000 just basis, and we're going to take $50,000 in depreciation each year. So after 2 years, the adjusted basis in the property, I'm about to screw up here, is $100,000. And it's sold for what? $180. So at the beginning of year 3, if it's sold for $180 and the adjusted basis is 100, there's an $80,000 gain. So we got to figure out how to allocate that $80,000 gain. Meanwhile, what is their capital account? This A got, I'll just spell it out longhand. Year 1 and year 2, $50,000 worth of depreciation deductions each year. So his capital account is 0. B's capital account at the very beginning is 100,000. So there's an $80,000 gain for tax and book purposes, right? And that gain should be allocated for capital account purposes and for tax purposes, $40,000 apiece. So all I was looking for is A is allocated $40,000, B is allocated $40,000. A's capital account goes up $40,000, B's capital account goes up $40,000. So that's all, nothing complicated. Just the partnership, they allocated the depreciation and then it just said that they would split profits 50-50. Anyone have a question on that? Nothing fancy.
Is this out of 100?
What?
Is this out of 100 or score?
This
The
what?
score on the front is out of 100. Like
On
on
the
the front of your
exam.
exam.
What was that?
On the front of the exam, is the score out of 100?
No, it's not that much.
No?
No. What was that, Ash?
That's what you have to start with. None of us can pay attention to the all exam.
What's it out of?
I mean, the high score, I think someone got a 76, was the high score. But the kind of scores I'm looking for, anywhere maybe, again, guys, I love being in front of here, I love teaching. Grading is not my, fun and games, it's not your fun and games to take exams. But people generally, I would say, who got above 55 and above, or probably the A range, maybe 40 and above in the B range. If you got below 40, you're going to probably be in the C range, somewhere along those lines. I mean, this is not cut in stone. I don't put down grades. I wait until the final exam and then I tally it. So if you ask me what your grade is, I did not put any grade next to your name. All right. So, and like I said, the final exam is going to count more heavily. So even if you got the 76, don't rest on your laurels. But if you got the 30, there's hope. But you got to put the work into it. I mean, again, if you look at these problems, I am not asking you to create the wheel here. These are just basic elementary problems that we covered each one of these chapters. And I'll do the same for the final. I will just pull out whatever problems we did and take a simplified version of that problem. And you'll see it on your final. That's it. Nothing, I have no secrets here. That's it. And the better you do, the better I'll feel when I go away for the winter break. So, I always say, my fate is in your hands. I really do feel that way. Like sometimes I look at an exam, like, I want to talk to the person and say, come on, what, or I feel badly, like, what didn't I communicate? So I'm here to help you. I want you to, I truly want you to master this, but you got to put in the time. You cannot just come to class not having read, and I'm not saying weeks get crazy and I know you can't always be prepared, but this course really requires more so than any other tax course, minimally 10 hours a week. I can't tell you, there's no shortcuts. No one can do this on the fly. No one can do this, I'll just give it an hour, I'll rush through. It just catches up with you. It's just impossible to really learn this. Go ahead, Andrew.
Just one comment on how you gave the test, which kind of threw me off my game, was the free response we collected it midway through.
I will try, Andrew, to get someone here. It's one of me, if I don't do it in some organized fashion, it just becomes so hard to collect things. So I will see. Kathleen was supposed to send me someone. I'm not faulting her, but the person got sick, and I couldn't. She wasn't sick, but her kids were sick, so I couldn't get that person. So and that was supposed to happen with my income tax exam too. So I tried, I understand, I will do my best so that doesn't happen. I can't get, coming here at night from 6 to 9 is not easy. Maybe Sharon, I can count on you to help me.
Sure.
Although, remember, you don't have to tape that night.
Right.
So
study
we'll
more
talk
on
about it. All right? So I'll see what I can do. If there's any other recommendations, room temperature, anything you guys want that I can help, I will try to make happen.
More time.
All right, we're going to have more time, but there'll be more questions. All right? I mean, but I got to run the balance because several people did finish beforehand. So
Did they finish everything?
they did. They didn't. No one who turned it in early.
Jesus.
All right. Question 10. A and B form equal partnership. They each contribute $20,000 cash. B contributes land with an adjusted basis of 9, fair market value of 20. Right? So keep in mind, B's holding a hot potato. Everyone agree? It's contributed property that's appreciated by $11,000. If the partnership sells the property for $19,000, right? Is this something new? Something you guys didn't see? Where you're like, oh my God, where did you get off asking this question? This is identical to the questions we did. I mean, even if you didn't know what you were doing, if you at least looked at the problem, you could have just changed the numbers and you had it in your notes and come up with the right answer. So in this case, the partnership sells the property for $19,000, and it's got an adjusted basis of 9. There's a $10,000 gain. Guess who's going to get saddled with that? Even though the property suffered a book loss of $1,000 and A would like to get a loss, there's no loss that can be allocated here. That entire gain has to be allocated to B. Under the remedial method, we can just wave our magic wand, right? A should get his, excuse my language, his frickin' $500 loss, right? He deserves it. The partnership suffered $1,000. He's a one-half partner. He should get a $500 loss. Well, if we're going to give him a $500 loss, we got to saddle B with a corresponding gain. So B not only gets tagged with his $10,000 gain, but he also has to pick up an additional $500. So the answer is $500 loss to A and $10,500 gain to B under the remedial method. I knew some of you would be upset. Actually, I was thinking of you would have been frustrated, right, Ashley? If I didn't ask Ashley, so if you have someone to blame for the next question, Ashley, you'll take the hit on it, right? And you wanted a depreciation question, right? Everyone, you wanted to see how to, and again, nothing new here, right? We have A and B form a partnership. A contributes property with an adjusted basis of 4, fair market value of 10, and B contributes $10,000 in cash and it's a 10-year recovery period, right? And we're going to use the remedial method. And if you recall, under the remedial method, we're going to have 2 assets, right? We're going to have one asset worth $4,000, and we're going to depreciate that over the remaining lifespan, which is 4 years, right? Right, Ashley? You did this, right? I don't even recall if I got it right or wrong, but.
I got the first part.
All right. And the second part, or the second asset, is anything above the adjusted basis up to fair market value, is $6,000. So we have 2 assets. The first is worth $4,000, depreciated over the remaining 4 years. The other asset is worth $6,000 for the remedial method. How many years are we going to depreciate it over? 10 years, right? Everyone agree? And we have 2 assets here. Asset 1 that is worth $4,000 with 4 years remaining, or $1,000 per year, right? And the asset number 2, this is the remedial method. You can pretend there's a second asset and it's worth $6,000 over 10 years, or $600 per year of depreciation, right? Remember, that's what we did. We made it into 2 assets. It's not me. This is the Treasury regulations. Straight from what your notes, the problem we did based on the textbook. So, if you recall, A and B, we have tax and book, tax and book. And you recall, they started off, A has 4,000, B had, the book is 10,000, and B contributed cash of 10,000. He's the non-contributing partner. And how much is the depreciation the first 4 years? It's 1,000 plus 600, right? Or 1,600 divided by 2 is $800 per year. $800 per year. That's the combination of the two assets. But there's only 1,000 of actual depreciation. There's only 1,000 of actual. So in that case, B gets 800, and the balance goes to the contributing partner of 200. And that's going to go on for 4 years. So this, after 4 years, is going to be 3,200. And that's going to be 6,800. It's going to be 6,800. It's going to be 6,800. What's going to happen the remaining 6 years? There's going to be this $600 fictitious depreciation. Doesn't exist. And we're going to divide that at $300 a piece, right? $300 a piece, A and B. And B actually gets it. B wants and deserves, as the non-contributing partner, to get $300 worth of depreciation. Well, if we're going to give him $300, we have to give A $300 worth of income, right? The quid pro quo for giving B tax depreciation is we artificially have to give A an equivalent amount of income. So the answer here, for year 1, the depreciation allocable to A is $200, the allocation to B is $800. In year 10, A is allocated no depreciation. To the contrary, he's actually allocated income. He's allocated no depreciation. Conversely, B is allocated $300 worth of depreciation.
So I put the 300 and you crossed it out.
After the class, Joe, if I screwed up, my eyes started getting blurred. So I'll take a look at it. All right? But that's the objective here. All right? So Ashley, you happy it's there?
Can't say so.
All right. But again, we did an identical problem to this. Identical. Just change the numbers. Okay. Last problem. All right. Okay. Let me concede. Okay, because I don't want you guys to think that. In my opinion, the first 11 problems, I would say, really not, everyone here should get 75 to 80% right. It's an exam, you're flustered, I get it, you don't get 100%, but you really should, the last question was more, just in case people were getting mad at me, this is too easy, I need to, so this is the one that I just want to make sure, that few people who said, I needed something more challenging. So here, look at problem 12. A and B form a limited partnership. A is the limited partner, B is the general partner. A contributes $360, B contributes $40,000. Okay? The partnership contains a minimum gain chargeback and complies with the qualified income offset. Neither has a deficit obligation. Partnership agreement provides all losses allocated 90-10, 92% to A, 10% to B. Then all income will be allocated in the same manner until income allocations equal previous loss allocations. Thereafter, Losses will be allocated 50 to A, 50 to B. The partnership borrows $1,600 from an unrelated commercial lender on a non-recourse basis and purchases real estate on leased land for $2,000. Right? So we have $1,600, which is borrowed, non-recourse. Okay? The only interest on the loan is due after 5 years, so it's a balloon mortgage, and the partnership breaks even except for depreciation deductions. Okay? So we're going to just have $400 worth of losses each year. Assume that on January 1st of year 4, the partnership sells the property for $2,400. Okay? So we want to know the capital account in year 1. Now, what do they start off with? 360 and 40, right? And we know the building starts off with $2,000. We have $400 worth of depreciation. That's $1,600 adjusted basis. And we're going to take another 400 after 2 years, another 400. So this becomes $1,200. Remember, this is minimum gain at this point because the liability we said was what? It's going to become is a balloon liability. I believe we said it's $1,600, right? So once we start subtracting downward, we're going to have minimum gain here of $400. But be that as it may, let's pause for a moment. So after year 1, what's our capital account? Well, this was not a, this is not a trick question. Okay? All I was looking for is we're going to allocate the deductions 90-10, right? That's it, 0-0. That's what I was looking for.
And again, I have 0-0, and again.
All right, Alicia, I'll take a look. I didn't have a vendetta against you. I can't explain. Okay? All right. Now, what's going to happen here after we're going to subtract? Can we go negative here? Why can we go negative? Because of the minimum gain chargeback. Everyone agree? So after 3 years, that should be our capital accounts, but now we're going to sell the property, right? And let me subtract here $400. What's our adjusted basis in the property? $800. And we're selling the property for how much? $2,400. And our adjusted basis is $800. So what's the gain here? $1,600. Everyone agree? After 3 years, we've taken that much depreciation, but now we're selling it for $2,400. We have $1,600 worth of gain. How are we going to allocate that gain? Well, first, how much was our depreciation? What were our deductions? $1,200, right? And we have to allocate those. Right? Everyone agree we took $1,200 worth of deductions, and they have to be reallocated 90-10. Everyone agree? Because that's what the partnership agreement says. That those, and by the way, that constitutes the minimum gain, right? That we, well, the minimum gain and also the prior depreciation deductions. So those had to be allocated 90-10. So you gotta add back 90% of 1,200 is 1,080, and then 120, right? I'm just,
What are we adding back? Depreciation?
we're adding back the prior deductions. The partnership agreement says any deductions you take, let's take a look. Partnership agreement provides that all losses will be allocated 90 and 10, that all income will be allocated in the same manner until income allocations equal previous loss allocations. So we had to take the prior loss allocations of 1,200, and now that we have income, don't shake your head, Karen, we have to reallocate it 90-10, which we did. We take this equals 1,200, we're just splitting the 1,200 back 90-10. Now, there's an additional $400 of income. The partnership agreement says once you've allocated your prior losses, so now the partners have been made whole for their prior deductions, take any additional income, and how to allocate the additional income? 50-50. So that's $200 each, right? And when you add all that together, should equal, I believe it equals 560 and 240. Check me on that. Okay? So that's what I was looking for. In A's capital count in year 4 is 560. B's capital count is 240. And the taxable gain to A is going to be 1,280, and to B, it's going to be 320. What is it? 1,280, 320. Now listen, on a Wednesday night at 8:45, it's going to be hard to absorb, this problem. But the first 11 problems, again, things you've already seen in one form or fashion. And let me just say this, for the final exam, sorry for the repetition, go through each chapter. Take a simplified version of each chapter problems. That's what you're going to see on the final exam. All right? That's it. All right? Benny?
So there's no need reading outside the book.
Benny, the only problem with not reading outside the book is that by not testing yourself with other problems with different numbers, it's hard to really say if you know your stuff. And I'm saying, guys, partnership tax, there's such lack of originality on the part of authors. So if you get some of the other books and you go through the problems, they're very similar to ours. So just test yourself. Andrew.
Do you know one of the supplemental texts that have the answers?
Yeah, the what's it called? The black letter series has answers. If you have a problem, let me know finding that book. The black letter series has multiple choice and essay questions with answers. All right. I'm sorry, Amber. You're whispering.
Can you send a link with that?
Just send me an email tomorrow and I'll try to send the link out, okay? Okay? I'll send you tomorrow, guys, I will send the link. All right, now, let's just finish up question 3, okay? On page 206. The equal partnership only has one asset. Building 1, which has a fair market value of $800,000. Adjusted basis of $300,000. C becomes a 1/3 partner by contributing building 2 with a fair market value of $700,000 and an adjusted basis of $150,000, which is subject to a $300,000 mortgage, which the partnership assumes. At which time C's contribution revalues the assets. How is that going to be allocated? On this question, as I read recourse out, what is the test, guys, for recourse liability? Economic catastrophe, right? Right, Benny? Okay, regulation 752-2. So what's your initial capital account, A, B, and C? How much? How much is the original capital account for A, B, and C, guys?
150 each.
Say again?
150 each.
150 each?
Yeah. 400.
400 each, right, guys? Isn't that what you would say economically is their stake in this enterprise? Right? They revalue the assets, right, to reflect their economic stake with the entry of a new partner. Agreed? Amber, you got that? Problem 3. So, what do we have to do? What exercise do we have to go through here? If the two buildings become worthless, right? If all the partnership assets become worthless, what kind of loss are we looking at monetarily? $1.5 million loss. Everyone agree? If the buildings become worthless, how would that be divvied up if they were equal partners? 500 apiece, right? Everyone agree? So what's the effect to C here? Say again, Joe?
C essentially gets debt related to $200,000, right?
C gets debt related to $200,000 because the other parties are bearing $100,000 of the liability. So it's considered as if there's a de facto distribution, right, to C of $200,000 of cash. And what was C's original outside basis here, guys? 150. Oops. That means C's going to have to recognize $50,000 of gain, right? Everyone agree? And A and B's basis will each, outside basis will each go up by 100,000. Right? We did a problem like this in chapter 2. Right? Everyone's got this? Tina, you got this?
What's the outside basis?
C's outside basis is 0. And A and B's, what was, I don't recall if we're told what A and B's original basis is, so I can't give you an answer there, Annetta. I don't know what the original, but whatever it is, goes up by 100,000. How's that, Annetta, for your notes? Ready? Question B. What results in A above if the liability is non-recourse debt secured by building 2? Okay, the partners agree to use the traditional method to allocate the 704C gain. Okay, now, it's non-recourse. Take a moment and think about that. That means, what is there in problem B that there wasn't in problem A? Minimum gain of how much? There's a minimum gain, right, of 150, agreed? That C does not shed. Everyone agree? C does not shed that 150,000 in minimum gain. That's under regulation 752-3A2. I'll repeat. Regulation 752-3A2. The other 150,000 of liability, of this non-recourse liability, can be allocated essentially in accordance with the partner's profits interest. Or if you look at the regulation without getting too, the revenue ruling 95-41, beginning on page 198. If you look at that revenue ruling, there's different ways to allocate the excess. For our purposes, let's just keep it simple and just say it's allocated in accordance with their profits interest. So C would shed 100 and A and B would each pick up 50. In question C, if C, instead of contributing building 2, contributes $400,000 in cash, and shortly thereafter the partnership incurs a $500,000 non-recourse loan secured by building number 1, how is the $500,000 liability allocated? I'm sorry?
Who's getting 100 and who's getting 50?
I'm sorry?
Again. Question B.
In question B, you said the first 150 represents minimum gain. The other 150 will be split in accordance with the profits interest. And since they're 1/3 profits each, of that $150,000 additional liability, excess liability, C is shedding 100,000, right? And A and B are each picking up 50 of that 100 that C is shedding. Right, Louise?
Or is it, if you get minimum gain, isn't there some number of savings too, or?
704C doesn't operate here. Look at the revenue ruling and you'll see there is no 704C gain the way you would think because of the book value of the property. Look at the book value. That's what the revenue ruling tells you to look at. Amen? Were you going to say something? All right. The last question. You know what? We'll hold off on the last question. I'll see what I want to talk about. Let me just talk about next class, guys. Chapter 7, compensating the service partner. This is not as challenging as 752. I always think 752, people can get a bit lost. We will go through Chapter 7. There's lots of cases here. There's no reason why we won't finish chapter 7 for next class. If you can, in addition to reading chapter 7, take a look at the first 5 or 6 pages in chapter 8, okay? Property transactions between partners and partnerships. All right, so it's going to be a pretty heavy reading as opposed to this week. There's a fair amount of reading for next week, but if you can, please finish chapter 7 and begin chapter 8. Amber, you were going to say something? I'm sorry? Not 100 pages.
Are you collecting these back or are we taking?
I'm sorry?
Are we taking these back?
Yeah, no, you can keep them. I gotta go back.